Okay, so we are going to solve this question, which is on marginal and absorption question. So first, how do you approach this question? How do you approach this question? Yes, you can help me. Oh, have you forgotten? Yes. The first thing you do is to write the name of the entity. Okay? Write the name of the entity. Cocoa. Hey, have processing company. Cocoa processing company. Then you go and read the requirements. Calculate the production cost per unit of cocoa tea using marginal and absorption costing. Prepare income statement for the first quarter using absorption costing, marginal costing, reconcile the profits. Okay. Now, ordinarily, right? Look at ordinarily, the question would have asked us to start from B here. The question would have said, prepare income statements for the first quarter using absorption costing or marginal costing, just like the question 7 here. Question 8. Look at the question 8. Requirement. You are required to prepare income statements. So if the question 2's approach were like question 7, question 8, workings, I'm doing my workings here. The first thing I would have done was to go with an acronym OMCO. OMCO, O stands for OAR, overhead absorption rate. M stands for marginal cost or absorption cost per unit. The C stands for closing inventory. The O stands for over or under absorption. Over or under absorption. So OMCO. So assuming this question, for example, if I'm to start, I'll start with OMCO. OMCO, O-M-C-O. Now, going back to question 2. Question 2 says what? Calculate the production cost per unit of cocoa tea using marginal cost and absorption question. So the question 2 didn't start with prepare income statement, just like the question 8, where I would have gone straight ahead and started from here. The question 2 says I prepare the production cost per unit of tea using marginal cost and absorption question, which it says I should work on. So now watch. From this OMCO, the question 1, is asking me to solve for the second M. Because that M contains what? The marginal cost per unit, absorption cost per unit. And that's what the question, then 1A is asking me to solve for. So it means that it's asking me out of the 4 steps I would have used to compute prepare the marginal and absorption costing method. Out of the 4 workings, the question 1A is asking me to begin to find the M on its own, separately from the remaining 3. Do we get it?
Okay.
Do we get it?
Okay.
Right. So now I'll go. Cocoa Beans by factory. A. Marginal costs per unit and absorption costs per unit. So what I'll do is I'll write a marginal costs Ghana cedis, absorption cost Ghana cedis. Then what goes into marginal costing? We just did standard costing. What goes into marginal costing? When you are computing a marginal cost, a cost card, what goes into marginal costing?
Direct material, direct labor. Production.
So what
Overhead.
are direct material, direct labor, and variable production overhead? What is the name of that cost called? So what we are trying to say is that I want to cost a product. So I want to cost a product. To cost the product, I'll first start with direct materials. Let's say 40. Direct labor. Let's say 20, 30. Then we'll go to direct expenses. Let's say 40. All these four, which is 110, it is called direct or prime costs. Then I add the variable production overhead. Let's say 15. This is 125. This 125 is called the marginal cost or absorption cost, marginal cost or variable cost, this of production. Then I'll come and add a fixed production overhead. Let's say that is 20. So with this 145, right, this is a full costs or absorption costs or standard costs. So the question is that when we want to cost a product, if we want to determine the marginal cost per unit and absorption cost per unit, we need to first find the direct material, the direct cost, all these people, we have to find them. Then before we come and add the variable production overhead. But here we don't have anything like of such or with such nature. So what do? We have to bring in the variable production. Variable production, that's 320,000. So we bring in the variable production. Okay, so let's start. So what are you trying to see here? I've not even started reading the entire data, but I'm working because when I read the requirement, it told me what I need, and I just started picking my figures from the question. I have to just come through all this immediately and pick my figures. You can go by that approach, or after the requirement, you go and read entirely everything. So somebody should read it for us. Be quick, be quick. So the approach, I'll first write my entity's name, go and read the requirements, then see what the question wants me to do. After that, you read through the passage. So that someone should read it for us. Let's be quick. Yes.
Cocoa Processing Company manufactures a single product with the name cocoa tea. The following figures relate to the cocoa tea for a 1-year period. Should I read the activity level?
Yes, read.
Okay. Activity level. Sales and production units, 40,000. See this? Revenue, 800,000. Production, fixed, 80,000. Sales and distribution cost, variable, 160,000. Fixed, 120,000. The normal level of activity for the year is 40,000 units.
Someone should continue, eh? Let's be quick. Let's be quick.
Fixed costs are incurred evenly throughout.
Fixed costs are the same as budgeted.
Rosemary, read.
Fixed costs are incurred evenly throughout the year, and the actual fixed costs are the same as budgeted. There were no inventories of cocoa tea at the beginning of the year. In the first quarter, 11,000 units were produced and 8,000 units sold.
All right, that's fine. So let's go. Variable production. So the first is that we should find the marginal costs per unit and absorption cost per unit. So we go with this. And I'm saying the marginal cost per unit, absorption cost per unit. Had the question not said we should find the A, but rather the B, the requirement B was the A. The first thing I would have gone with my UMCO acronym, and I'll just be working to follow it. So definitely I would have still come to find this, the M, the marginal cost per unit, but that one would have been second to the step. But the way we should first the M, we should find the M. Therefore, if the M is out, I have three more stages to go. So value, and we're saying that when we are costing a product, we need the direct costs, which consists of the direct expenses, labor and material. And then we add variable production overhead, then we get the marginal cost of variable costs. So in this question, that's a marginal cost or variable cost of production. Now, in this question, they didn't give material labor. They rather gave the variable production costs. So it's assumed that in this variable production cost of 320,000, all the materials anybody are in. Are you good? Are you good?
Yes.
So what is the variable production cost? It's 320,000. It says you find cost per unit. So 320,000. There are two ways you can solve it. Divided by how many were produced? 40,000. How much does it give us?
8.
8. Absorption costing. Does it also involve marginal costs?
Yes, sir.
Yes, because from what I explained here, the difference between the absorption costing and the marginal costing is what? The fixed production overhead. Are we okay? Are we okay?
Yes, sir.
So it means that in the absorption cost too, the marginal cost is in, because it forms part of the computation of the marginal cost. Now we go. The fixed production overhead, fixed. How much is it per unit? Marginal cost, does it have any fixed production overhead? No.
No.
So we'll say 80,000 divided by what? 40,000. How much is it?
2.
2. Mm-hmm. 10, right? Is that correct?
Yes, sir.
That's it. This is the question says calculate the production cost per unit. So this is a variable production, marginal costs, fixed production, margin and absorption. That's how you're going to have it. So that's all for the A. Let's go to the B. Question says prepare income statement for the first quarter using now. So assuming the question had asked me to start from B as my A, I would have written my UMCO somewhere. And I'll start with the O. So I write here workings. The first O is called OAR. That's a fixed production overhead absorption rate. OAR, the formula is, let's say, budget total. You can say budgeted fixed production overhead or total budgeted or total fixed production overhead all over total activity level. So here we'll say total fixed units. So total fixed production overheads. OH is overheads over. Are you all following?
Yes, sir.
Yes, sir. Yes, sir.
So total fixed production overheads. OH is overheads over total fixed production units. So what's the fixed production overhead? Fixed production overhead, yes.
80,000.
What are the total fixed production units?
40,000.
40,000. So you see, the normal activity for the year is what? 40,000. So whenever you hear the words like normal activity, words like normal outputs, planned outputs, normal output, planned output, and sometimes they will say fixed production units. They are mostly referring to under this concept and question, they're referring to the fixed production overhead. I get it. They are referring to the fixed production units. Okay. So total fixed units, we have what, 40,000. So when she said 40,000, this was where my mind came to, not up there. Okay. What's the figure?
2.
Yes,
True.
true.
2 cedis.
The unit. So what is always said or assumed to be true is that this OAR figure you see here, this relative production overhead, mostly it is the same as what? The OAR. Are you good?
Yes, sir.
It's the same as the OAR. So whenever you see the OAR to be true, know that if you know the fixed production overhead to be true, know that the OAR is true. Whenever you see the OAR to be true, fixed production overhead is also true. What's the next? So the OMCO, where 1 was taken out, we have 3. We have 3. So the 3, what is the first one? OAR. We solve for the OAR. We should have solved for the M, but the question have asked us to solve for the M above. Okay, then we have closing inventory. We have the closing inventory. We have the over or under optimization. Sorry, over or under absorption. So let's go. We are done with the O. The M is the first question we solve. So let's go to the C. So working 1. Working 2, you have closing inventory. For you to always remember the closing inventory, we go with the acronym sales equals open and close. Sales equals open and close. Then what we do is you will make closing inventory the side, which will be closing inventory is equal to what? Open and what? Sales. So we begin the opening inventory, production, and sales. That's the order in which we write it. So opening inventory. And also you check the timeline in which you're operating. It says prepare the income statement for the first quarter. So first quarter here. Right? What's the opening inventory?
There was no opening inventory.
There was none. So I'm writing in this order. Sales equals open and close. So open, production, sales. Right? And we have here close. We have here also what? Closing inventory. Are we good?
Yes,
Yeah.
Are we
sir.
good? Are we good?
Yes, sir.
Yes, sir.
I'm taking my time so I understand it. Okay. So it says production, opening inventory was 0. Now, production, how many are going to be produced within the year?
11,000 units.
11,000 is here. So it's the first quarter. We are considering on the timeline, first quarter. So first quarter is 11,000. What if they said in the, okay, that's fine. Then here, we are going to have sales here. How many are going to be sold in the first quarter?
8,000.
8,000.
Then from the closing inventory equals sales equals opening inventory, production and sales. It says the sales should be negated. What do we have?
3,000.
1,000.
So the first quarter, they will end the first quarter with 3,000 cedis as closing inventory to be an opening inventory for the next quarter. Are we good?
No.
So again, are we good?
No, please.
Why don't you get it?
Kindly explain the closing inventory again.
The closing inventory, keep this acronym in mind. Sales is open and close. So between the O and P, you add, the P and C you subtract. We are searching for product this. So let's make closing inventory the subject. Who should be equal to O plus P minus S. Are we good?
Yes, sir.
So in this order, I have written this. So the opening inventory first, production second, sales next, but the sales should be negative. Then when I add this and subtract that, they should give me the closing inventory. That's what I've just done.
Okay.
Any other question? Now the next stage is what? You find the AMCO, over or under absorption. That's what we're going to find next. So assuming the question had never asked me to find the A would have been part of the AMCO. So after the OAR, the next one is I would have done the A. The A we just did up there. I would have done it as my second working before going to closing inventory per the steps here. Then I'll go towards over and an absorption. So here it will be my third working. It will be my third working. Go and watch the video so you over and under what? Absorption. Okay, so over and under absorption, we write the first quarter. I'm going to solve it in two parts. First quarter. Here, I'm beginning with the currency sign. Watch, I'm beginning with the currency sign. So I'll write actual here. I'll write budgeted here. Now, we are concentrating on production. So whenever I say absorption or to be absorbed, you must bear in mind the word OAR because an overhead kind of thing I'm going to compute. So actual, how many was actually produced? Mostly, as I stated earlier, whenever we say the normal activity, the normal output is the same as the planned output. You can say the same as the fixed production unit. It's not the same as the actual units produced. So normal output, planned output. Are you getting it? Fixed production units. So for the quarter, it says that what over or under absorption, we want to know first, all these are on production. How many were produced? What's the normal activity level? Or what's the normal output? What is the figure? What's the normal activity level figure?
40,000 units.
40,000.
So read it for us. Quick.
The normal level of activity for the year is 40,000 units.
Now, this is for the year. That's what I wanted you to read, for the year. But which timeline is the question asking us to work with?
First
First
quarter.
Quarter. And we have 40,000 for a year. And we say we should find the first quarter. How do we get the figure?
you divide it.
Divide
By what?
by 4.
How many quarters in a year?
4 quarters.
There are 4. So we divide it by 4. Then when you divide it by 4, to give you for a quarter, you absorb. Absorb means multiply by the OAR. What is the OAR?
2.
2.
2
2
cities.
2 cities, not 2. 2 cities. Yeah. Yeah. That's the OAR. So you absorb it. Multiply by 2. What do you have?
20,000 cities.
This per quarter. Budgeted. How many were aimed to be produced? How many were aimed to be produced at the end of the year?
11,000.
So at the end of the quarter, how many?
11.
11,000. The first quarter, so 11,000. Absorb. What do you multiply by?
The
By
OAR.
2 cities.
What do you have?
2,000.
22,000.
Take the lower from the higher. Take the lower from the higher. What do you have?
2,000.
2,000.
If the company's actual production should be 20,000, then their budget is 22. Have they over budgeted or under budgeted?
Over.
Then we call it over absorption. Are you getting it?
Yes, sir.
Yes.
Are you getting it?
Yes, sir.
Yes, sir.
Another method, first quarter. Yeah, I'm not using money, monetary value. I'm writing units, then actual, budgeted. How many should a business produce in a quarter? It should be 40,000, the normal activity level. Over 2, which gives us what? Which is, sorry, over 4.
20,000.
Over 4.
Quarter.
Yeah, thank you. Which gives us what? 10,000. But how many were budgeted to produce in the first quarter?
11,000.
You write 11,000 here. What's the difference? What's the difference? Difference means subtract
1,000.
1,000.
1,000. Yes.
So what we budgeted to produce that we produce against what is produced every year and this per quarter, have we over budgeted or under budgeted? Look at the budget figure. Look at the actual figure. Have we over or under budgeted?
Over.
Over. So we call this one overproduction. We have overproduced. It's units, not money. So to change this to units, we will absorb it. So we will say over absorption. We're not going to absorb it. So this 1,000, what will I multiply by? Absorb.
Yeah. By the OAR.
What is the OAR?
2.
So what is the figure?
2,000.
It's the same here. Choose the method which is easier for you. Don't go and show by solving those two, just one. And then you are good to go. Guys, are we okay? Are we okay?
Yes,
Yes,
sir.
sir.
So assuming I'm solving question 8, which says prepare, you are required to prepare an income statement for Kaduna for the period using both absorption and marginal cost. The first thing I'll start with, after I write the entity's name, the first thing I'll start with is with the OAR. After the OAR, my working 2 will be the marginal cost per unit and absorption cost per unit. Uncle. My working 3 will be my closing inventory. My working 3 will be my closing inventory. Here. The working 4, we will handle the over and under absorption. Are we good?
Yes, sir.
So I'm done with my workers, all workers. Now I will start with the main work. So these workings can fit one page. You move to the next page. You move to the next page. The next page. Oh, hold on, sorry. The next page will begin with. Now we're not going to solve the question. All these workings were for the um B to enable me approach the B. So now I've got my workings out. Let us go to the B. The B is a repair income statement for the first quarter using absorption costing. So I write the name of the MTT. Cocoa Production Company. I think it's right. Okay, Cocoa Processing Company, CPC. Cocoa Processing Company. Then we start with what? So it's a prepare income for the first quarter using income statements for the first quarter using absorption costing. Here we are only dealing with one quarter. So we can say Ghana city here. Ghana city here. Then we'll begin with what? Sales. The sales figure. How many were sold? How many were sold?
8,000.
So
8,000.
go to working two. Working two. Working two. This is the sales figure. You pick the 8,000. Multiply by what is the selling price? To find the selling price, you find the total sales, which is here is called the revenue. Total sales, which is called revenue here. This figure. We want to find the selling price per unit. Every year they produce 40,000. They sold 800,000. What is the selling price per unit? We'll say the 800,000 cedis divided by what? The 40,000 units. Right? What's the figure? What's the figure?
160,000.
What?
160,000.
160,000.
160,000. Then we go to less cost of sales. Then we go with, so watch. I'm still using this. This. Sales equals what? Open and close. I've written sales. What is the next one? Opening inventory, production, closing inventory, which is the same as what is here. I'll just copy this without the sales. Or I'm using what is it? I'm using this one. Sales equals open and close. Right? So sales equals open. So opening inventory, open O and production and closing inventory. Do you get it?
Yes, sir.
Good. Now, what is the opening inventory? I'll bring brackets against each. Then I'll write the units. The unit pair, they're working three. This is working three, closing inventory. Opening inventory was 0. Production was 11,000. Sales was 8,000. We've already dealt with sales. Opening inventory was 0. Production was 11,000. Closing inventory was 3,000. So this is 0. This is 11,000. This is 3,000. Then we will multiply the cost of sales by the marginal cost. Sorry, we are dealing with absorption cost, so by the absorption cost per unit. Absorption cost per unit. And we solve for the absorption cost per unit here. Here. This is absorption cost per unit. This is absorption cost per unit, which is 10 cedis. So we can multiply the opening inventory, right, by the absorption cost of 10 cedis. Production, because this is cost of production. Are we good? Are we good?
Yes, sir.
So watch. It is called cost of sales. Cost of sales means how much did you spend on what you sold? And these are direct expenses. Cost of sales means how much did you spend on what you sold? So absorption costs. So which costing method are we using? We are using activity-based cost. Or, sorry, we are using absorption costing. So it means that it is absorption cost of what? Sales. So if it's absorption cost of sales, we can calculate this as cost of sales. There's also another method. When we finish, we'll see whether we'll get the same thing. Okay, we'll see whether we get the same thing. So now, we will multiply the opening inventory units by the absorption cost of sales, which is 10 per unit. Production is 11,000 by the absorption cost of sales, which is 10. Then closing inventory. Okay. Now watch. Multiply. 0 by 10 is what? 0. 11,000 times 10. What do we have?
110,000.
110,000. Closing inventory is what? 30,000. You subtract. I'm following the sales equals open and close. I'm following this. Add, subtract.
So please, where did you get a 10 from?
Where?
Did you get a 10 from? 10 Ghana cedis.
Where here when I did working 2, working 1, the first one. Here.
Oh, okay.
The absorption costing per unit. Yeah.
All right.
So that's it. What is the difference?
80,000.
Pay attention. I'm going to do something. Are you sure it's 80,000?
Yes, sir.
Yes, sir.
So watch. Okay, 10 absorption cost times 160. And this is correct. Is this correct? 800 over 40. Okay, 2816. Okay, that's fine. 80,000. Now let's proceed. Now, what do we do next? When is absorption costing? The over and under absorption. This. Over and under absorption. So it goes with the absorption costing. It goes with the absorption cost. So we bring it down here and write over or what? Under absorption. What was the final output? Was it an over absorption or under absorption?
Over.
Okay, so we write over absorption. So watch. Whenever it is under absorption, whenever it is under absorption, it means that the budgeted, right, is less than the actual. It means that the budgeted is less than the actual. It means you add to cost of sales. Whenever there's an under absorption, you less from sales. Whenever it is over absorption, whenever there is over absorption, you add, you subtract. So here, just learn for one. Here, when it is over under absorption, we add to cost of sales. So if it is over, we will rather subtract from where? Cost of sales. Are you good?
Yes, sir.
Whenever it's under absorption, we subtract from sales. But when it's over absorption, we will add to sales. So just learn for one. The opposite is the other one. Are you okay?
Yes, sir.
And whenever it is an over absorption, it means that they over budgeted. The budget was more than the what? Actual. So here we are having over absorption. We will see whether what we are doing is right or wrong when we do reconciliation. Let's see. The over absorption is saying that we got to 2,000, right? Right?
Yes, sir. Yes, sir.
And this 80,000 is called cost of sales. This 80,000 is called cost of sales. So if the 80,000 is called cost of sales, and over absorption is saying that whenever it's an over absorption, what do we do? Do we add or we subtract to cost? Do we add to
Less.
cost of sales or we subtract from cost of sales?
We
Yes.
subtract.
Subtract.
Less, we subtract. So 80 minus 2 is what? 78,000. And this 78,000 is called total absorption cost of sales. This is 78,000 for the cost of sales. Are you good? And it says less it's. When you less it from 60,000, what do you have?
82,000.
What?
82,000.
82.
Yes.
Now watch something. As I was saying, this is cost of sales, right? So when you say cost of sales, we are dealing with absorption costs method. So I can say absorption costs of sales. Are you good? Now, what is the absorption cost per unit? What is the absorption cost per unit?
2 cedis. 10.
Beautiful. How can I say 2 cities?
10 cedis, please.
Here. Absorption cost here is 10 cities. Pay attention. I want to teach you something. 10 cities. Off means times. How many were sold? How many units were sold?
8,000 units.
8,000. 8 times 10, what do you have?
80,000.
This is 80,000. This is here. Do you get it?
Yes, sir.
So when I can use this method, it will give me the cost of sales straight and I'll move on and I'll finish the work in no time. It is correct because I use this method. However, I'm using this method because you'll be fine, you'll be better with this. Are you okay? Are we okay?
Yes, sir.
Now we'll continue. This is 2,000 is called gross profits. Gross profits. Then, when it comes to absorption costing, after we got the gross profits, we less non-factory, non-production, non-manufacturing overheads. When it comes to gross profits, we less non-production, you can say non-production costs, non-production overheads, non-factory costs, non-factory overheads, non-manufacturing, non-manufacturing costs, non-manufacturing overheads. Whichever one you write is correct. So we are trying to take out all costs which are not production. So let's go to the question. Give me costs which are not production. Mm-hmm.
160,000. That's for
I want the
variable.
name. Good. Variable what?
Variable cost.
Variable what?
Cost.
No. It is called variable selling and distribution. So there's just selling and distribution. They have two divisions. They have the variable, they have the fixed. Do we get it?
Yes, sir.
So you have variable selling and distribution costs. Then I'm going to write variable selling and distribution costs. How much is it?
160,000.
So you write here 160,000 divided by what? 40,000. Variable selling, does it go with sales or distribution?
Sales,
Sales. So you multiply by how many was sold.
8,000 units.
Yeah. So how many? What's the total cost?
32,000.
Then we move on. Fixed production, fixed sales and distribution costs. Fixed sales, fixed sales and distribution costs. This one is how much? 120,000 for the whole year. How many quarters do we have? 4.
So
So how much is it?
30,000.
What do we have together?
62,000.
So we less. What do we less? What do we have?
20,000.
These 20,000 is called net profits. Why am I dividing the 160,000 by 40,000? To know the selling price for that year. To know the selling price for that year. It might be that year, 160,000 is what they sold. Then what was the amount, what was the cost, sorry. What was the cost for that year? Then they produced 40,000. So how, all this, the total sales was 40,000. So that will give me the selling price for the entire year times how many they sold that year, that first quarter, sorry. So 160,000 is for the entire year, the amount, the total variable cost for the entire year is 160,000. And they sold 40,000 units. That was the activity level, the whole year. Right? So those two give me the selling price. Then we will multiply by how many they actually sold the first quarter. So what we are trying to say is that we are trying to find the variable selling distribution cost. How much did they spend? Right? How much did they spend on what the variable cost was? How much did they spend? Particularly on the 8,000. So that's why I divided by 160,000 divided by 40,000. Why didn't I do the same for the fixed? Fixed selling distribution costs, they do not change regardless, or they don't vary with respect to the activity level or the output. So if 120,000 is for the whole year, divide by 4. Every month or every quarter, it is fixed at 30,000, regardless the unit sold or produced. But with the variable, the 8,000 can change. If this quarter is 8,000, it means next quarter it can jump to 10,000, can increase or decrease because it's a variable cost. But a fixed selling and distribution cost, it doesn't change regardless the activity level. Guys, are we good?
Yes, sir.
Is it difficult? Is it difficult? Is it difficult?
No, sir.
Practice, practice. Okay, we are done with the first part. So we are done with this, we are done with this, we are done with this. Let's go to the next part. So now, let's start with the next one. We go with the name of the company again, Cocoa Processing Company. Cocoa Processing Company. Cocoa processing company. Watch. You begin. Income statements. I've taken my time. Oh. I can really finish this in no time. Income statements for the first quarter using marginal costing. Then, just like the first, watch Ghana cedis. Ghana cedis. I'll begin with sales. The sales, I go and copy the same under the absorption. The same thing there. So sales is what? 8,000 were sold times the revenue of 800,000 divided by how many were sold or how many units were sold, which give me what? 160,000, the same. Then I'll go with less cost of sales. This cost of sales is not absorption. This is less a marginal cost of sales. So underline. I'll go to the working 3. This working 3. Yeah, closing inventory. Yeah. And I'll copy it again. I'll copy this side. Now I'm done with sales. So sales is out. So I'm left with what? The sales equals open and close. I'm using the sales equals open and close. So the sales equals open and close. Sales is out. What is left? Opening inventory. What is next? Production. What is next? Closing inventory. This was 0 in units. Just as is here. I'll copy here, like here. This is 0, 11,000, 3,000. It's the same in the working 2. 0, 11,000, 3,000. The 8,000 I've already used for sales. So I'm just going to repeat them down there. 0, 11,000, 3,000. Then what do I multiply by? Marginal cost per unit. The E, which would have been my number 2. The marginal cost per unit, the MC, this 8 cedis is the full marginal cost per unit. So I will multiply it by what? 8. So times 8 cedis, times 8 cedis, times 8 cedis. Do we get it?
Yes, sir.
So 0 times 8 is 0. 11 times 8 is 88,000. 8 times 3,000 is what? 24,000. What do you have?
64,000.
64,000.
What?
64,000.
Now watch. If they said costs of sales, but which costing method are we using? Marginal costs of sales. What is the marginal cost per unit? 8 cedis, right? And off is times. How many were sold? How many were sold? Sorry. How many units were sold?
8,000.
What do we have here? Oh, multiply it and give me the answer.
64,000.
54.
It's the same here. So I can also use this SMART method and I'll get the same cost of sales. But let's stick to what we are doing now. Is Adelaide here? Adelaide.
Yes, yes, yeah.
I'm here.
When you say visa was say.
Ofele Mintia.
Be careful. Okay, guys, let's continue. Now, after this, we will add all variable costs. So we go to the question. All the variable costs, are going to add them to it. Why? We want to find the total marginal costs. I get it. So what is the variable cost? Not variable production. Oh, don't forget, we've used the production already. So you're not going to use this again. We've used it to find the 8 cities. It's in the 8 cities. So the next one we go for what? Variable selling. Variable selling and distribution. So we go forward, variable selling and distribution costs. Then we would say, so when you go to variable selling and distribution costs, watch. We will come and copy what is here in the absorption. The same thing. We copy the same thing and write it here. So 160,000 divided by 40,000 times how many was sold? 8,000, which gives us what? 32,000. Is that the only variable cost there? Yes. We close it off. What will the final figure give us? 96,000, right? Is it 96?
Yes.
This
Yes.
96,000 is the total marginal cost. Is the total marginal cost. We take it from 160,000. What do we have? What do we have? What do we have?
64,000.
So this 64,000. The 64,000 is called contribution. 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 So what is contribution? It is the total, what is total contribution? Is the total sales minus total marginal cost. That's why we have to bring the variable selling price or variable selling cost and add it to the cost of sales to get the total marginal cost of sales. Are we good? Are we good? Hello, are we good?
Yes, sir.
Always, contribution is used to pay for fixed costs, so less fixed costs. All fixed costs, whether they are production, they are not production, every one of them comes in here. So what's the first fixed cost we have there? Who can tell me the first fixed cost? Look into the question.
80,000.
What?
Is it 80,000?
Good. So fixed production overhead. Overhead is a cost. We have overhead. We have indirect costs. We have direct costs. The indirect costs are called the overheads. So when I say fixed costs, I'm talking about both indirect and direct. So fixed production overhead. How much is it? It is 80,000 in the whole year. This is it. Watch. It says figures relate to the cocoa tea for a 1 year period. 1 year. So this 80,000 is for 1 year. Are you going to record everything?
No.
What do we do?
We divide.
Divide what? Divide by 4. Because we are working on only 1 quarter. Which will give us how much? 20,000. Are you getting it? Are you getting it?
Yes, sir.
Which other fixed item is left? Which other fixed item is left? Have you seen it?
Yeah.
Fixed selling and distribution cost. Fixed. That one is left. So fixed. The fixed cost is not saying fixed selling or fixed over. It says fixed cost. And I've said the cost, we have two parts of it. We have the indirect and direct. We also have what is called production cost, and we have what is called period cost. This is fixed selling and distribution what? Costs. So that too, we will say 120,000 divided by what? 4. Just as it's here, I'll copy the same thing. Fixed selling and distribution cost, this. I'll copy the same thing, write it below. What do we have? 30,000, correct?
Yes, sir.
Total 50,000. Subtract from what do you have? 14,000. What's the name of this figure? What's the name of this figure?
Net
Net
profit.
profit. Net profits. Are we good?
Yes, sir.
Are we good? Is it difficult? It's not. Practice, 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 practice. That is all. Now, next portion of it. The C says, we are done with this. The C says reconcile the profits. So C. Are you guys writing?
Yes, sir.
Reconciliation of profits. That's all. So there's the first quarter. We are working on first quarter. Don't go and write a year. Ghana cedis. Let's bring the marginal cost profits first. So marginal cost profits. What's the marginal cost profit? Or let's say the net profits. Or marginal costs net profits. How much is it? 14,000. We will leave a space here, like 2 spaces, and come and write absorption costs and profits. Absorption costs, and net profits. How much was it? What was the profit figure?
20,000.
20,000. Then we ask ourselves, what do we do to the 14,000 to arrive at 20,000? Do we add to the 14,000 or do we subtract?
We add.
All right, here, add. Add, let me say, inventory. Now, this inventory is deemed to be like an overhead. All right. So if I say add inventory, there are 2 ways I can do it. Let me bring the OAR. What is the OAR figure?
2.
2 times, go to the working 2. From here is working 2. But if it's the OMCO, it's working 3. The closing inventory. So I'm going to say OAR times closing inventory minus what? Opening inventory. That's what I'm going to do here. So this is the OAR, right? This is the OAR. So what is the, these 2 series. What is the closing inventory? Let me go up and show you.
3,000.
Yeah. I'm still working on here. This is the closing inventory. I'm going to subtract the opening from it. So the closing inventory is what? 3,000 minus, what is the opening inventory? 0. So multiply all. What do we have?
6,000.
Positive, right?
Yes.
So indeed, 14 plus 6,000 is what? 20,000. That is one method. This is also another method. Or Ghana cedis, first quarter. Marginal costs, costing net profits, 14,000. Then we have absorption costing net profits, 20,000. We add still, right? And right here, inventory. Then we bring with the OAR. The OAR figure is what? 2 series. Multiply by. Then we ask ourselves, what do we do? What do we do to the 14,000 to get 20,000? We do we add or we subtract? We add. So I've written add inventory. Then what figure should be added to the 14 to get 20,000? Is 6,000. Then I'll divide this 6,000 by the OAR, which will give me what? 3,000. We have reconciled the profits. We have reconciled the profits. Are we good?
Yes, sir.
So that's all. We have finished with solving question 1. A similar approach is question 2. So let's look at a question 8 here. Okay, this is a question 8. In the question 8, we were given the selling price. We were given the direct wages. So here, unlike the first question, we only give the production overheads. So here to find the marginal, the OAR, it says you divide. Let me end the session so that I'll finish it.